There are many interesting businesses overseas, but with over a decade of strong performance from U.S. equity markets, non-U.S. equities have been virtually ignored in many client portfolio allocations. So how can a bottom-up approach be used to select a group of world-class businesses? And why does that matter to you, an investor? We're going to get to all those details right now on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm your host, Anthony Pastore. Please join me in welcoming Roy Leckie, who is a member of Walter Scott of BNY Mellon Company, back to the studio. Roy, it's good to have you here.
Delighted to see you again, Anthony. Thank you for the invitation.
You had a little bit of a U.S. whirlwind tour coming from Edinburgh to our side of the pond. So lots of conversations with U.S. investors and advisors. Indeed.
Been jumping around a little bit, but it's wonderful to be here. We're very well supported by our U.S. client base.
Excellent, excellent. So let's get into the whole international equities part of the story, which is what we're here to talk about today. And look, they've had a pretty volatile start to 2024. You know, U.S. equity markets have generally done well. There's been a little bit of volatility there as well. What's the optimistic case for U.S. investors who want to look overseas in some of those international developed markets?
So, Anthony, you can come at it from a few different angles, to be honest. I mean, clearly there's a lot going on in the world at the moment, lots to worry about outside of the US. So there's the geopolitics, the Russia-Ukraine situation, of course, is ongoing, the tragedy in the Middle East. A lot of investors concerned, misplaced concern largely to our mind around China's military intentions with respect to Taiwan. So lots to worry about if you're an international investor, but just as relative valuations appear to be at an extreme point, the most important investment fundamentals between the US and non-US markets is actually converging. Most importantly, I would look at profit growth, or the outlook for corporate profit growth. The non-US markets, or those markets represented in the MSCI EFA index, for example, the corporate profit outlook there is really pretty good as it's been for a long time relative to the US. As I say, just as valuations are reaching a kind of extreme divergence. So I think that there's a real opportunity there from that kind of high-level perspective. But of course, Walter Scott is stock pickers, and from the stock picking perspective, this is also a great time because there are just so many really exciting growth vectors accessible to international investors right now. So, you know, for example, the Italians and the French, they do absolutely retain this very strong comparative advantage, global comparative advantage when it comes to luxury products. There are some amazing Japanese factory automation or industrial automation companies. There's an amazingly exciting growth dynamic with regards the Asian savings and protection markets. So as a stock picker, accessing the opportunity set in overseas markets gives you, I think, something very different to what US investors are exposed to if they purely retain a home bias.
Yeah, it sounds like there's a lot of diversity, sector diversity, as what you're saying, as far as opportunities are concerned internationally. You mentioned Japan. I'd be remiss if I didn't ask you. By the way, as we're sitting here recording this, the Bank of Japan has not had their next meeting. Probably by the time people are watching this, it may have already happened. But they are one of the few central banks around the world right now that's contemplating raising rates, as opposed to on the U.S. side. We might see a cut or two, although these days with inflation. What is next for the Bank of Japan when it comes to rates? I mean, the first time they raised rates was the last meeting in March, and that was the first time in 17 years.
Yeah, I mean, Anthony, I have to say I'm delighted that Japan is back in the kind of spotlight, back in focus for investors around the world, having been in the doldrums for so long. That being said, we've found Japan very fertile territory, actually, as stock pickers. I referred to this earlier. There's some brilliant companies in Japan. It's just that there hasn't really been a kind of top-down case.
Right.
And I think that's starting to change. I think we can get a bit more excited about the kind of top-down case for Japan. We don't want to get ahead of ourselves. And I think the kind of 25 basis point increase, or the removal of the ultra loose monetary policy, it's probably more symbolic than anything else. I don't think it really matters that much for the stock picker. I think if Japan's current bull run is to be sustained, what we really need is sustained corporate profit growth. Right. And I think the outlook for that is pretty good. It's not a dead cert. There will be some companies that do better than others, obviously. But I think the kind of top-down case for Japan, as symbolized by this Bank of Japan move a few weeks ago, does portend to better days ahead, certainly compared to the kind of deflationary funk that we've been exposed to for the last decade or two.
Exactly. Yeah, it's fascinating to see how Bank of Japan Governor Ueda is kind of trying to fight inflation, or at least he says if underlying inflation continues to go up, they're very likely going to have to raise rates again. But obviously, we'll have to stay tuned. Kind of switching again, looking at, I would say, maybe high-quality businesses in the international segment. Now, here on the U.S. side, our chief investment office is really looking at high-quality stocks, high-quality fixed income. On the international side, how are high-quality, companies like they're best positioned to kind of fight those geopolitical risks that you were talking about, sort of the macro developments? What do you see in that space?
Look, I think there's great uncertainty around the investment world at the moment.
And investors, by the way, are rightfully nervous about it.
Yeah. So to us, that means that this is absolutely not the time to compromise on quality.
Right.
A lot of money is lost when quality is compromised going into a period of uncertainty. Now, you can define quality in lots of different ways, and it's about for us, it's about sustainability of growth. It's about high return on invested capital. It's about management quality. And crucially, and I think this is the bit I would emphasize now, Anthony, it's about balance sheet strength. And I think this is going to be the factor within quality, or the aspect of quality, that is going to be the most important for the next few years.
They're a little expensive, though, aren't they?
So sure. Many so-called quality companies do look, in absolute terms, to have high valuation multiples. But again, I don't think you should focus solely on one or two valuation metrics that do look high relative to history or relative to the peer group. I think it's always crucial to assess, for each unit of PE that I'm paying, what am I getting? How much growth am I getting? And what is the certainty of that growth? How much return on invested capital, return on equity am I getting? And as I say, most crucially, what strength of balance sheet am I getting? So yes, some valuations do look high relative to other parts of the market. There are swathes of the market that actually, as a long-term investor, you just don't want to go anywhere near.
That makes sense.
But when you analyze, and you've got to dig deep here. You've got to really research your companies and understand what you're buying. But there are opportunities for high quality companies at valuations prevailing today to make good money over the medium to long term. And I think crucially to protect on the downside, and the balance sheets of the companies we're trying to expose our clients to are going to offer significant downside protection should. Or I'm going to say when the turbulence really hits, because we haven't quite yet had the pain that I think years and years of loose monetary policy, very, very low cost of capital. We're out of that now. And we're about to hit a wall of debt refinancing across the world, and stretched balance sheets. Companies with stretched balance sheets are going to be in trouble.
Right. So it's the high quality side of the balance sheet seems to be a better place to be potentially putting your money to work. Roy, thank you very much. Thanks for the insights. We rarely get a chance to talk about what's happening in international developed markets, especially on the equity side. So good to have those insights from you today. Great to see you.
Thanks, Anthony.
Thanks.
Good to see you.
Great, good to see you, Roy Lucky. And for more information on anything we talked about today from partners like BNY Mellon and Walter Scott, please make sure to check out our website, ubs.com/views. There's lots of great info up there for you. That's our insights page. Plus, you can follow UBS on social media. We're on Instagram at UBS Trending is one of those accounts that you can follow. You can check out all the content that's up there. Plus, all the other Facebook and Twitter and LinkedIn content is up there as well. And as always, if you have any questions about your portfolio, make sure you're talking with your financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everyone. And remember to keep your eyes on what's trending. We'll see you soon.